And I'm really glad to talk to this guy who I've been talking to now for a long time, ever since his days at JP Morgan. So this is a pleasure. Tom, I want to get right to it and talk about how you're thinking about some important big macro issues. And we might as well start with the Fed, since we are 2 days out now from the biggest Fed meeting ever, since the last Fed meeting that was the biggest Fed meeting ever. And I'm just curious how you're thinking about the framing around the size of the cut and what we might hear from Jay Powell.
Thanks, Julie, and great to see everybody here. I do think Wednesday's an important day because it is the beginning of an easing cycle for the Fed, and one that is reversing a lot of the monetary tightening they did because of inflation. So to me, this is a Fed that's supporting the economy, has, I think, an implicit put because they don't want the labor market to stumble, and a big part of that is making sure companies are confident, which means they do want asset prices to be stable to rising. So I think it is a huge deal that this is a cut. Markets have a lot of concern. I know the prior panel about whether it's a recession, but let's say that our base case is it's a no landing cut that's taking place. This really could look like 89 or 95, where this really lights up the cyclical stocks.
And so for all these folks out here who are looking at this cut and trying to figure out, I'm probably getting a lot of incoming questions from clients about, okay, what changes on Wednesday and what changes beyond Wednesday and what do I need to do differently with my strategy? How are you answering that question?
I think there are going to be some abrupt forks in stocks. As you know, and I'm sure your friends know, anyone who's been wanting to buy a house has been sitting on their hands because of mortgage rates. And this is going to really be the first window in more than 2 years where adjustable rate mortgages, HELOC, even fixed rate mortgages get cheaper. And I think it really motivates buyers. I think you're going to really see housing inflect. And we know it's going to have something similar in business loans, in merger activity, credit card delinquency rates. I think there's quite a lot of pent-up demand because CEOs have been cautious for 2 years. So to me, I think groups that have been not participating, it's been mostly a FANG market for the last 2 years. It really flips to one that's small caps, financials, and industrials.
And does that unlocking of demand happen with the first cut, no matter what size it is, or is it going to take a little while?
Markets are forward-looking, and the Fed's 80% of their tool is communication. So I don't know what the Fed's going to say Wednesday, but I imagine they're talking about a new parameter of moving back towards neutral. And a neutral rate, let's say, is 2.5%, 3%, and we're at 5.5% now. I think the stock market is going to start thinking about the idea that rates are going to come down. What does this mean for PE multiple? What does it mean for small caps? What does it mean for financials, which have really been harmed by this, high cost of deposits? I think there's so many things that turn on this.
Let's dig into some of those, and then I want to get to the next catalyst after the Fed that you're already looking to. But some of these calls that you're talking about, particularly small caps, is something that we've been hearing about this year. And it hasn't borne fruit as of yet, really, right? We've seen sort of some feints in that direction, rallies in small caps, and then they've sort of faded out. So was it just that people were waiting for the actual cut?
Yeah, I think small caps haven't worked for a couple of reasons. One is, it's dependent on money flow, and I don't think investors have any conviction about anything other than tech until they know the Fed is in an easing cycle. And I think they need to hear it Wednesday. Of course, we have election day, so there's another thing, and markets want to get behind them. But I think a mistake people make is thinking small caps, because they don't work now, will never work. Just remember last year in 27 trading days, they went up almost 40%. I think the setup for them to outperform into year end is even stronger. So small caps, I think, are going to surprise people.
what else is going to surprise people? I mean, I know you mentioned financials, and recently there were some negative headlines around the financials because of some commentary, particularly from JP Morgan, about the street maybe overestimating net interest income growth. Does that give you pause at all when it comes to the financials?
I mean, you have to definitely pay attention when JP Morgan, which is one of the best operating banks, makes comments like that. But I think the big opportunity is really in the regional banks once the Fed starts cutting, because the Fed shifting towards becoming a dovish Fed is going to put a floor on a lot of hard asset prices, and it's going to allow cap rates to actually fall. This is a big tailwind for regional banks. So I think regional banks' earnings are going to show tremendous, there's even an accounting change that'll show because as deposit costs fall. So I think regional banks could do very well.
You mentioned the election, which is the next catalyst that I was referring to. And I recently heard you say, which I thought was interesting, is it doesn't necessarily matter who wins for the markets. It just matters for us to get past it. Can you expand on that a little bit?
I think all the advisors here probably relate to it, but you probably have a lot of clients that are sitting in a lot of cash because they were concerned about inflation, and then they are now concerned that maybe markets could be recovering. But I don't think anyone wants to allocate until after Election Day. And part of it is the emotional nature of this election. I think it's a really divided electorate, and people really have their preference. And we may not even know who wins on Election Day. And of course, as you look at betting markets, it's a super close race. I mean, this is basically 50-50. Personally, I don't think it matters who wins, because I think both policy agendas aren't that different from what equity markets should do. But I think there's actually pretty important sector implications.
So why don't we get into that a little bit? And I think that's interesting, and just to put a fine point on that, because certainly I've talked to a lot of people who have said, at the margins, maybe it matters for corporate tax policy, for example, who wins, although Congress is going to be important for that. What sector is it most important for?
Well, if I was to make a quick checklist, to me, the biggest policy difference is Bitcoin, because one candidate is running on a pro-Bitcoin platform, and even the idea that Bitcoin becomes a treasury asset. So one thing you can do is if Bitcoin's rising, it's starting to bet on a Trump win, but Bitcoin hasn't because it's 50-50 right now. But I think the second is that if Trump wins, I do think it's going to be viewed as CEO confidence rising and deregulation. And so that's more of a merger cycle, pro-cyclical, and I think small caps actually would really strengthen if the market thought Trump was winning. And then I think energy does worse if Trump is president because of expanded drilling.
What happens to Bitcoin if Harris wins?
I don't think Bitcoin necessarily responds to a Harris becoming president, but Bitcoin will then focus on a dovish Fed, because in an easing cycle, this is obviously a big tailwind for risk assets, and that would be bullish for Bitcoin. So,
sorry, Tom, I'm laughing a little bit because people who like Bitcoin say Bitcoin's going to go up no matter what happens.
Since 2009, Bitcoin has gone up no matter what happens. It has. Interestingly, as people doubted Bitcoin, when we first wrote about it in 2017, we had pointed out that 90% of the move of Bitcoin is explained by the number of wallets and the activity per wallet. And so we said, even if you don't believe in it, if it's going to grow by 2022, Bitcoin could be 22,000, and it was 1,000 at the time. It was just on the idea that the number of wallets would go up. And today, 90% of the move of Bitcoin is still explained by the number of wallets and activity per wallet. So it's going to go up really no matter who's president.
So you're talking to an audience of people, many of whom this year have had access to crypto for their clients for the first time in a lot of new ways. What should be the allocation for the average person?
Our official recommendation is 2% for clients. I think much higher if they're younger. To give you some perspective, when we first advised 1% in 2017, either 1% Bitcoin or 0.5% Bitcoin and 0.5% Ethereum, that 1% of Bitcoin, what they didn't sell, is 40% of their portfolio now. And if they held their Ethereum and Bitcoin, that would be 80% of their portfolio. So I think it's a 2% bet on an outsized benefit. Plus, you have a lot of hedging against, a potential calamitous outcome.
I want to circle back to stocks because you also are sort of historically known as a bull when it comes to stocks. I think it's fair to say. Your firm target for the S&P 500 is still 5,200. And you and I were talking a little bit off stage about why you guys have not changed it yet. Why don't you tell these folks a little bit about your thinking around that?
Yes, our original S&P target for 2024 was 5,200, but a year ago in December, that was one of the highest targets because it was about 20% upside from early December. S&P was up 10% in the first half of this year. And since 1928, it's 23 times that you've been up more than 10% in the first half. In the second half of the year, the median gain is 10, and it's up 83% of the time. The only years the S&P didn't rise in the second half after a 10% gain was between 1970 and 85, which is when Volcker was chairman. So we have a dovish Fed. I think the second half of this year is going to be at least a 10% gain. But the reason we didn't raise our target earlier is, as you know, if any time this year you raised your target, people were going to chase it right away. And we don't want people to be chasing the market until probably after November because we are in a tough seasonal period. I still think the Fed move is going to be positive for stocks. But as you know, we started off September down 4% in the first week. Since 1928, if you took the 10 worst first weeks of September, and that's 2.5% or worse, 0 out of 10 times September was positive for the month. If you took the 20 worst first weeks of September, you're 0 for 20 that September's a positive month. So I think we're in a period where the seasonals put a really high burden on markets to do well. I'm not bearish for the year, but I think between now and election day, it's maybe tougher.
I want to turn to what Chris mentioned in the beginning, which is that it's your 10-year anniversary at Fundstrat, founding Fundstrat, this day exactly, ironically, coincidentally. And I've watched your career. I'm sure a lot of the folks out there have watched your career with a lot of interest, going from a big Wall Street entity like JP Morgan to starting your firm to really it becoming a force. How'd you do it? And is this sort of the way you set out to do it, or did it kind of evolve along the way?
Yeah, we've accomplished a lot in 10 years at Fundstrat, and we have many folks from Fundstrat here. We have Carrie Presley, heads our media, and we have Tireless Ken right there, and we have Steve Quinn, who's head of our Fundstrat Capital, and Mike Longthorne, who is on the institutional side. And when we started Fundstrat, our vision was that we were pretty bullish on the idea that investors were going to really benefit from having a lot more tools with technology. And so we wanted to democratize institutional research. So we wanted to take what we had done at JP Morgan, which primarily served hedge funds and institutions, and make it available to a bigger audience. And that's been kind of our mission, but in a way that would be understandable for folks. And so, we did accomplish a lot, so we're pretty happy about it.
And I'm just curious, in the beginning, was it sort of a slow burn and slow growth, and then at some point you had a big acceleration, or has it been sort of off to the races from the beginning?
The first few years of Fundstrat, we were an institutional-only firm, but we were positive cash flow from the first day, thanks to my former employer, which was our first client. and so they're becoming our client, paid for everything. And we've grown mainly as a step function, I think. We launched an FS Insight product in 2019, and today that serves over 8,000 RIAs and family offices, and our institutional business has clients in 26 countries, and we have partnerships with several large investment banks in Latin America and Japan and Korea now to be the white label research provider. So we really do touch a lot of folks. And over the next 10 years, we have 30 full-time employees roughly, and we have a lot of ideas about how to really build upon what we've done over the next decade. So very excited to be coming to work every day, I guess.
Yeah, and you guys now have 300 hedge fund clients and about 8,000 RIA and family office clients across 26 countries. You do a lot of social media. You do a lot of media generally. What sort of do you find the most effective in terms of branding, in terms of getting the word out?
This is something that I think our company recognized pretty early, was that the next generation of investor is native digital. We did a lot of work on demographics at Fundstrat. That's one of our cores, was the idea that millennials were really a significant generation, and we did a lot of work. Actually, Snapchat was one of our consulting clients, and we did work for them. And so we knew that you had to reach them native digitally, and it wasn't through email and print magazines. And so we saw social media as important, really Twitter at the time. And I don't know what folks think of Twitter today, or X, but to us, it's still there's only two places that we find that real financial news breaks outside of linear TV, like outside of the broadcast networks. It's really Twitter or Reddit, and it's not other social media platforms. So, for us, we did invest a lot of time on X, but I think what we found was our approach to social media is similar to our approach in research. We just want to give people as much evidence as possible, and we give them our probabilistic view of what happens, but we do stay away from opinions, and we obviously mix in a bit of, if you follow us on Twitter, you see we do mix things in with some humor. And one thing that we do as a company is we have a lot of critics. I think people tend to bark back at critics with anger. I think it's a lot better to just make humor of the critics, and it's sometimes funnier that way, or it's usually
and not ignore them. You engage with them.
Yes, yeah, I engage with the critics just because I don't know why they're so angry at us. I think they lost money, but I didn't force them to trade against us or whatever. So, but you know what? I think we found over time some of them have gotten embarrassed and apologized to us in person for saying they hated us for so long, but then they finally decided to buy Tesla and then they were happy or whatever. So.
Well, it's a lot harder to be a critic when you haven't met somebody in person than when you're saying it to them personally. What is some of the most popular content for your clients? What are they really clamoring for?
Well, I guess for folks who use our work, they really like our macro framework, and we share that in a video. And they also like our core stock models, because our core stock portfolios have been driven by a thematic approach. I think one of the things that has made us different is we are thematic focused. So we look at big story arcs. So in 2018, for instance, we wrote about the need for automation because of global labor shortage, but our conclusion for that was that there'd be demand for AI. And so, we started this thing called the Granny Shots Core Stock Portfolio, which was built around these themes, and we just bought the strongest stock. So when it came to AI and automation, and Tireless Ken did the original list, or helped us with it, we put things like NVIDIA in, and these are just long-term holds because and if you think about the stock market, you just want to buy the best companies in the strongest themes, and that's what you do best for your clients because that's how you buy NVIDIA at $41. Or actually, I think this is split adjusted, so I mean, this is how you get the 20x, 30x returns on stocks.
And speaking of granny shots, you guys are introducing an ETF soon, I believe, that has those granny shots in it. What made you decide to finally, after 10 years, or maybe it was 10 years and you thought, 10 years, now it's time to do an ETF?
Yeah, so we do have an ETF filed called Granny Shots, ticker GRNY, and Steve Quinn is going to be heading that for us. But it was actually born out of interest from our clients because we had a core stock portfolio list called Granny Shots, and the published track record is since 2019, each year it's outperformed the S&P, so never had a single underperformance year, even this year outperforming. And so they were tracking our changes that we would publish quarterly, and it's like a 30, 40 stock portfolio. But then after a while, they just asked us if there was a way that we could just handle those changes for them because they were having to buy and sell at every rebalance. And so I think that was the sort of engine behind the idea that they'd prefer us to offer one single product that they could actually allocate towards.
Gotcha. We do have a couple questions up on the board, and I want to get to at least one of them because you were talking earlier about small caps, and I think you, besides all of the other things we've been talking about, you're of course known for your bullishness on certain tech stocks. You sort of alluded to that with your AI theme. Is your now preference for small caps, does it come at the expense of some of your large cap tech holdings, or are you saying maybe people should reallocate, or is it an all of the above situation?
I think everyone has to look at large cap tech, especially the US Mag 7, as stocks that you kind of want to pass on to your grandchildren because these companies are so dominant globally. The best AI and technology companies are only American companies, and their lead is because of this ecosystem. And if you've seen our work about AI automation, we think the world is short close to 80 million workers. That's like $4 trillion of revenue of wages that have to be replaced by tech spend. So I think this is very early for tech. But small caps could be starting a 12-year cycle of outperformance that's like 1999, and that means you almost hold it for half a generation. I wouldn't really be selling tech to buy small caps, but maybe you'd be selling your cash or your bonds to buy small caps.
And specifically within tech, there were some headlines on Apple today, some more concerns about iPhone 16 shipments. I mean, how much do you pay attention to that sort of shorter term ups and downs, worries about phone cycles, et cetera?
For anyone who's owned Apple a long time, you know that there are 18-month periods where the stock absolutely stagnates because of concerns about the product cycle. And for years ago, many concerns that it should just be trading at a hardware multiple. And that's really not what Apple is, right? Apple is one of the most important products in a consumer's life. It has become a branded name. I mean, that's the thing. So is there something that's going to topple Apple or reduce your relationship over time? I don't think so. Apple's share of your wallet is going to grow over time, and that's why I think Apple is going to recover huge.
But is it going to be less of a profit engine than it was, for example, if you're buying a new phone every 5 years instead of every 2 years?
I mean, Apple, I know it's funny. I've seen the jokes where people like say, the iPhone 16, and they have like a meme of a guy showing like a plaid shirt he got last year because it's the same shirt. I think Apple can have incremental margins that will surprise people because it's not just that they're selling you a device. They're really selling you, your gateway to the digital world. I mean, if you think about it, everything that you use on social media is actually a screen on the Apple and the iPhone, you know? And so I don't think that there is a real, you know, existential risk to Apple being a central part of your life. So do I think that means margins come over time? That would only be margin pressure if someone was developing a competing product, but there is nothing that's even close to how your relationship with your iPhone is.
And whenever we talk about AI and Apple, I don't know how many of you guys are Curb Your Enthusiasm fans and saw Larry David screaming at Siri when it did not understand his directions properly. And I keep thinking, okay, is AI going to solve that for Larry and for all of us? I don't know. Is it?
Yes, I do think AI. I've heard. I don't remember who said it. Was it Sergey from Google? But you know that in the future, the AI is going to be a PhD level person that you're interacting with, and I would say that vastly changes things. I mean, I think.
Right, but how close is that? Because like last year at this time, it seemed like that would be happening by now, to listen to some, and it ain't happening now, right? So, you know, and it sort of keeps feeling like it keeps getting pushed off that level.
Yes. You know, this is a step function change that's coming with AI, but this is a bad analogy, but when I was a cellular analyst in the 2000s, early 2000s, cell phones were primarily just for phones, but companies like Nokia were introducing bigger screens and people learned to text. But I remembered, and Steve Quinn, when I were working closely, that around 2003, color screens started to come out. And people talked about the idea that it could be like smartphones, and you could do mobile web on your phone. And it was inconceivable to people that you would do stuff on a desktop internet browser that you would do on this crappy little screen. And people even said, why do you even need color screens? And then, of course, remember when the iPhone was finally introduced in '07, which was really the finest version of it, you know, a competitor mocked the iPhone saying it doesn't even have a keyboard. So I don't know. I think that we're the wrong judge of what AI is. The generation that's going to adopt AI is really somebody who's in their 20s now. And I think that they are going to be very early adopters. So I think we're just being impatient because we have our own template of how we view the world, but it's going to be very different in 5 years.
Are you saying we're old, Tom? All right, I'll leave it there. Thanks, everybody, and thank you, Tom Lee. Really great conversation. Appreciate it.